All right, guys, welcome back. So in this one, we are going to look at actively managed mutual funds. So we have, we're back at Fidelity's platform, investment products, mutual funds. We're going to come here. Now, these have all of the domestic equity funds, which are US-based companies. And you see large, small, mid cap companies. Now, value, blend, and growth are different categories of companies. So companies that are large, but also those are classified as growth. Some are blend value, which means that they're maybe not growing as much, but they're very consistent, very reliable. You think about blue chips this way, blue chip stocks. They're paying out a dividend. Instead of reinvesting the money into growth, they're sharing profits and they're just rolling along. And then blend is a mix. So you get all of that for large, small, and mid cap funds. Now, the other thing you can do is international funds, right? They have their own mix. So you can get a sustainable international equity fund and look and see what that even is. What is their thesis? What is the fund trying to do? What is their niche? Where are they focused? And what are their underlying holdings? You can look at regional and single country funds. So China, emerging Asia, Europe, Latin America, right? So anything like that, Fidelity Climate Action Fund, Enduring Opportunities Fund, Global Equity Income Fund, emerging markets. Yeah. And then we're going to look at sectors. Here you can kind of hone in and zero in on something based on the type of company that it is as far as the industry and sector it's in. So communication, there's a telecommunications portfolio, select wireless portfolio. Consumer discretionary are companies that provide items that are not necessities to clients, right? So like maybe new cars, hotels, flights, movies, things that you spend when people have excess money above their needs and they want to go have fun, right? Theme parks, whatever. All of those are consumer discretionary, just things you spend extra money on. Consumer staples are the necessities, right? Toilet paper and soap and toothpaste and flour and sugar, like all of those staples, no matter how the economy's doing. When the economy's bad, people spend less on these fun items, right? They tend to be more picky about where they spend. Consumer staples, no matter if the economy's bad or good, everybody's still buying soap. It's the bottom line. Okay, energy portfolio, financials, tracks banks, brokerage, financial institutions, industrial, so aerospace, alternative energy, select transportation, you have healthcare, there's biotechnology, there's medical devices, pharmaceuticals, information technology, et cetera, et cetera. Okay, you get the idea. So utilities, right? Gas, electric, internet, stuff like that. You can narrow in just about any which way you want. And there's a manager on each of these their job is to know the industry, know the sector, know the companies, and manage the best portfolio. So what we're going to do is we're going to come over to domestic equity, and we are going to pick out of this large growth category, we're going to pick Fidelity Blue Chip Growth Fund, FBGRX. That's their little ticker. So we have Fidelity Blue Chip Growth Fund, and we're going to look at the same things here. We're going to look at the snapshot. So 5-star rating, cool. High returns, average expenses, and risk is slightly higher than moderate. And we're going to look at the average returns. Year to date, down almost 13%. If you remember the S&P 500, down 5. This one's down almost 13. What is its benchmark? Oh, hey, look, it's Russell 1000 growth. So this is a different benchmark. It doesn't benchmark against the S&P 500. It benchmarks against this other one, okay? So we can't really compare this fund with the S&P 500 because they're different. The makeup of them is different. So 1 year is 0.96%. The average over the last 3 years is 25.89. Average over 5, 23, just over 23%. Average over 10 years is 18.5. So you can see that it's been beaten up more recently in this kind of down market that we've had. But over the last time, it's actually performed better than the S&P 500. But let's check out and see how it does against its own benchmark, the Russell 1000 Growth Index. So that one's blue. Mutual fund is purple. You actually see mutual funds beating this one out. So it's actually outperforming its benchmark over the last 10 years. So that's pretty good. So let's look over here at the details, right? So it's large growth. It was created in 1987. Expense ratio, 0.79. It's quite a bit more, right? Actively managed. That's why. You can see how many millions and billions of dollars are in this fund, but 0.79% expense ratio. So if you're looking at net returns, let's look at this in more detail here. Even though it has higher expenses, it's outperforming. So if you could go get a Russell 1000 Growth Index fund and you can invest in that and say, hey, I want to have lower expenses. But in the end, if this fund is giving you a better net return, then who cares about how much you're paying? So it's not all about the fees. It's not about index versus passive, or passive versus active, if there's an actively managed fund that is outperforming its benchmark, then, net of fees, then that fund is worth it. So it beat it this year by 2%, beat it this year by 6%, this year by 1.5%, this year by 0.5%. This year it lost by 6%. 5.5%. This year it beat it by 6%, beat it by 2.5%, etc. You can look at that across time. 2020, this one had 62% return. The Russell 1000 growth, 38%. That is a massive difference. And if we look at the life of the fund, you're going to see the 1 year, 3 year, 5 year, 10 year, and the life. 13.5% compared to 12. So it's beating its benchmark. So is that fund worth it? Worth the extra expense? Probably is. I mean, I personally don't care. I just want the returns. I don't care about the fees if you can justify them. So this fund is doing well. It's justifying. That's why it has such a good rating. Let's look and see who this guy is. Sonu Kaura managed it since 2009. He is the fund manager. You can look at the current funds that he manages. So he manages quite a bit, but they're all pretty much related. Previously managed a ton of other ones, education. So you can check him out. Like, okay, hey, he's got a pretty good track record. Smart guy. There you go. There's a lot more you can check out there. Now, we're going to look at the top 10 holdings. Okay. There are 454 holdings. The top 10 make up 50% of the portfolio. So we're going to see some similar names as before, but again, it's a different benchmark. It's a Russell 1000. So Apple, Microsoft, Amazon, Alphabet, Nvidia, Meta, Tesla. Marvell Technology is different. Lowe's is different. Salesforce is different. But they've put a lot more into those, and those companies have outperformed. And so probably what's driving the bulk of the performance here is the fact that they have overweighted these massive companies, and those have been hugely successful. It's pretty simple, pretty straightforward. So yeah, that is this fund. Now, if we want to go back and look at a different fund, I want to try and find a fund here that is focused on as the S&P 500 as a benchmark. It's Russell 1000 value. Not quite. Oh, hey, here's a good one though. Fidelity Growth Company. This fund is an interesting one. It's extremely popular. This one tracks against the Russell 3000 growth. And as you can see the performance, it has blown its benchmark out of the water. That is a massive difference. Okay. Fees, 0.79. So that's pretty reasonable. But look, it's closed to new investors. Every once in a while it'll open, then it will close. Okay, you can look at the performance over time. Over the lifetime, this has got 15%. It's beaten its benchmark. Been around since 1983. And the companies, you could probably guess what some of the top companies are. Nvidia, Apple, Amazon, Microsoft, Alphabet, Lululemon, that's a new one. So that gives you an idea of how to search for the funds, what's out there, how to measure it. I don't like looking at short-term performance. I don't invest in things based on short-term performance. I look at the long term. That's why I like the 10-year and the life of the fund. And I like to see the fund manager. So this one is Steve Weimer, fund manager since 1997. That tells me a few things. Number one, it tells me that this guy is consistent. He has a very long track record, basically 25 years. 25-year track record in this fund, and he has consistently outperformed the benchmark. So that gives me pretty high confidence that he could continue to do it. That's really what I look for here, is consistency and track record. Now, past performance is not a guarantee or indicator of future performance, but if he has a good track record and he's done well, it means that probably his approach is pretty reasonable, and there might be down years, but he has a reasonable approach that bears out over the long term. That's it. So for this fund, totally happy to pay my higher fee to get an actively managed mutual fund because it is outperforming its benchmark. So we're going to wrap up this video here. In the next one, I'll show you how to search and kind of compare mutual funds to one another. But I hope you guys found this helpful looking at some of the actively managed mutual funds that are available. All right, we'll see you guys in the next video.
If you found this breakdown helpful, stay tuned for the next video.